Hello, everybody.
What's up?
So weekly Friday live.
Yeah, let's do it.
I never introduced this because you do better. So this is Edgardo Valentine and this guy.
Yeah, I'm that guy. Let's just leave it at that.
We're in the Naples office today.
Holy crap! I just got a text from my daughter. So my middle daughter started driving this week. She turned 16. Shout out to Layla. And it is freaky crap, man. I don't know. It's weird. Anyway, all right. So look, man, we're going.
My daughter is 9. So
yeah, just
by the time she
like
can
this.
drive, but by the time she can drive, cars will be driving themselves.
Let's hope so. So look. So we're changing format this time, right?
My mom is watching.
What's up, Mom?
What's up, Mom?
Mom, what's up? I want to meet you one day. All right.
All right, so yeah, we're
at least people rely on Mom.
Yeah.
All right. So look, we're changing the format. Dude, we're starting off rough today.
I know.
So we're changing the format, man. We decided we're going to answer the top handful of questions about first-time home buyers per Google.
Per Google. Which
Okay.
It's a good source for questioning. Right?
Yeah. I'm sure if you guys have heard of that, it's a search engine. So let's just
jump in.
First question, simple. What qualifies you as a first-time home buyer? Go.
All right, so a first-time home buyer is somebody that hasn't owned a home in the past 3 years.
3 years.
That's it. So that means that if you had a home 5 years ago, or 6 years ago, or 4 years ago, and you haven't owned a home in the past 3 calendar years, then you're considered a first-time home buyer, and that's it.
All right, next, what programs are available for first-time home buyers? I'm going to handle this one. I know we've done videos on this. A lot fewer than you freaking think is the answer. So many people...
or a lot fewer are exclusive to first-time home buyers.
True. So a lot of people meet with us all the time, and they're like, I'm a first-time home buyer. And we're like, that is just awesome. I mean, it is exciting to help a first-time home buyer. It's one of our passions.
That's right.
But they have this mindset that because of that, it opens up these doors for no money down and all these other things. And truth is, almost exclusively, all of those programs are available for first-time home buyers and non-first-time home buyers.
And that's the key there. It doesn't mean that if you're a first-time home buyer, you don't have access to these. It means that even if you're not a first-time home buyer, you still have access to all these programs, or to the vast majority of these programs.
Absolutely.
As a matter of fact, a lot of those great programs you can even get even if you still own a home.
A current home. Absolutely.
So you don't have to be a first-time home buyer to take care of all these programs. You don't have to be a first-time home buyer for FHA. That's one that we get all the time.
We get it all the time. So, look, it's cool if you're a first-time home buyer, but whether you are or not, if you are struggling with down payment, this, that, and the other, you're good. Next, how much should a first-time home buyer put down?
Well, it goes back to the last question. Whether you're a first-time home buyer or not, what we really care about, the main question that we ask is, are you going to live in this property? Is this going to be your primary residence? Because there's 3 types, right? It can be your primary residence, which is where you go to sleep every night, right? That's 100%. Your home. It can be your second home, which is a vacation home, right? Mm-hmm. Or it could be an investment property, which is just strictly you're just going to put a renter in there.
But let's dive into the question though from a different angle, and that's all great information. But how much should you put down on a property is a big question, because it really involves a person's overall financial world, man, right? So,
well, but before we get there, though, what's the minimum down payment? Because the question is, what's the minimum down payment?
0 is the answer.
If you're going to live in the property,
it's 0.
The answer is 0.
It's 0.
Now, most programs require anywhere from 3 to 3.5. When we're talking about conventional loans, absolutely. FHA loans, no help whatsoever. Right. Just your typical FHA, your typical conventional, 3% for the conventional, 3.5% for FHA. Other than that, there's a bunch of programs with 0% down payment.
100%.
You don't have to put 10 or 20%.
Including our conventional 101% program that we've got a lot of traction with.
But
anyway, so yeah, look, I mean, we got to look at the big picture of things, man. Are you buying a house and it needs work? Does it not need work? Generally speaking, I am not a fan of limping into the front door of your new home and having $12 in the bank.
Sure.
I think we got to leave some cushion. Now, that being said, I do plenty of loans for people that are in that exact situation. That's just the way to make it work.
And sometimes that's the best situation.
100%.
That's better than renting, for
100%.
example. But it matters what you're saying. It matters their particular situation, And how long are they going to stay in this house?
How long are they going to stay in the property? What is their income situation? Do they have disposable income? If they wipe out their savings, can they rebuild it?
Right.
If they wipe out their savings and they get into trouble, do they have a plan B? Plan B could be a 401k. Plan B could be mom. Right?
That's
I mean,
right.
so all of those things go into that question. It's a big, meaty question. The next question is, I'm going to call it a silly one. What is the maximum income to qualify for first-time home buyers?
The maximum or the minimum?
It says maximum, man. I'm going this. Mo income, mo better.
That's right.
I just, you know, the more income, the better. I mean, there is no maximum now. I think where that question's going, now that I think it through, we have the home ready programs and things of that nature. There are some programs that are income restricted. Now, this is a big topic, but one rule of thumb is a lot of the programs that have income restrictions are very often, the restriction is 115% of the median area income. Now in Lee County, that number is 63.7. I just happen to know. So 115% of that is $73,255. So now there are plenty of programs with little or no money down that don't have income restrictions, but if there are income restrictions, you're probably going to be in that range in Lee County.
Yeah,
I don't know the Collier County number, but it's bigger.
But check this out. I love those programs like that because there's that while that is true, it depends on where you're buying the property too. Not just countywide, but within the county. Because there's a lot of places within the county that even though the program itself has income restrictions, if you buy in one particular area that doesn't have those restrictions, then you can make as much as you want and still benefit from those programs.
Yes, and please don't think that you have to work or move into a bad neighborhood for that. Mm-hmm. There's plenty of great neighborhoods. So look, again, you know, everybody's situation is different, programs, blah, blah, blah. If you make a lot of money, please don't think it excludes you, because it just flat out doesn't.
And the way you make the money matters too. See, we've gotten creative with those programs. Those are great. But the point is, the more money you make, the easier it's going to be for you to qualify for 99.999% of the programs.
100%.
And there's no such thing as, again, going back to FHA or going back to a regular conventional loan or a VA. There's no such thing as, oh, now you make too much money, we're not going to lend you money.
Yeah, that's silly. That's silly. Now, the next question you're too young for, so I'm going to address, okay? Is there still a tax credit for first-time home buyers? So you don't know what this is about because you were still in school, but for those of you above the age of maybe 35, you might remember that after the crash, the federal government offered a $7,500 tax credit if you bought a home.
At closing?
No, on your taxes.
Okay.
So literally, if you owed $10,000 in taxes at the end of the year, they'd reduce it to $2,500, and if you paid that much in, you actually got that refund. It was a really nice program. That thing is gone. So no, that's not a thing anymore.
Wait. Are there tax benefits of owning a home?
Well, that's it's a great segue into the next question. Does buying a home help with taxes? If you young guys, man, you go too slow with this crap, man. We'll get there. Do you want to address that in light of the new tax plan?
Well, regardless of the new tax plan or not, the answer is yes. There are tax benefits to owning a home. But now, with the new tax plan, it's less exciting for most people. Because most people are going to take the regular deduction,
the standard
which
deduction, is now $24,000 for married.
Exactly, instead of itemizing. So whether they own a home or don't own a home, it's going to be the same if they take that standard deduction.
Yes.
However, if you just want the straight up answer, yes, there are tax benefits. It's just with this new tax plan, not everybody's going to benefit from it. Now, when it comes to the taxes on the property, when you own a home in general, whether you have a mortgage or not, there are benefits like the homestead exception here in the state of Florida.
Yes.
So it is still beneficial to own a home rather than to rent.
100%. Yeah. And look, the next question: what can I write off when I buy a house? I'm not a tax professional. Are you a tax professional?
I'm not.
We're not tax professionals, but look, generally speaking, you can write off your mortgage interest. Okay. You can write off your property taxes.
That's right.
Okay. And you could very often write off your private mortgage insurance.
Yes.
There's income restrictions on all this, and let's throw a disclaimer in there.
Points and things like that.
Yeah. Some of the closing costs can be, etc. And by the way, big home improvement items can be. Right. Energy improvement features to the house can be written off.
Which, by the way, we have an amazing loan for that.
Yeah.
I know we're not talking about that right now, but we have a great loan where you can buy the property and put features that are going to help your house be more energy efficient. And it can be like insulation. It doesn't have to be like a Tesla roof.
Right. Which is the coolest energy efficiency thing on the market, hands down.
But it could be as simple as insulation or something like that.
Better windows.
And the rate is the same.
Absolutely.
It's a great program.
So look, there's a lot there. I'm going to throw that disclaimer out there again. Please consult your tax professional.
Right.
But generally speaking, if you are itemizing, there's a lot to itemize in your home. What is the highest tax bracket for 18? I'm just skipping over that. The more the better. Can you deduct real estate taxes in 2018? I just addressed that. Come on, Google, give me something.
Can I itemize?
All right, yeah, that's it. We've got it. We've somehow gotten into tax questions, man. What the heck? Let's do mortgage. If I can learn how to type. Let's do FHA. See, my Google froze up, and there goes the end of. There we go. FHA loans.
Anyways, we have that solar program, which is. It's great. 3% down payment or 5% down payment, and you can add anything really that we can prove that will make your house energy efficient.
All right, so look, I just Googled FHA loans. I came up with another list of questions. The first one, is it a good idea to get an FHA loan?
It depends.
It really does depend. There's a real negative with FHA loans nowadays.
Which is the mortgage insurance.
Being permanent.
Right. The mortgage insurance, technically, if you put 10% and you wait 11 years and that never happens, then the mortgage insurance goes away. But realistically, if you go on an FHA loan, you're probably going to go in with 3.5% down.
Yep.
And that mortgage insurance is going to stay there forever.
Now, you can refinance out of it.
You can refinance it, yeah. But if you keep that loan, the mortgage insurance is going to stay there forever. In contrast, if you get into a conventional loan and you put 3% down, once you've paid 20% of that value, then the mortgage insurance drops. Now, this doesn't mean that FHA is a bad loan, because in a lot of cases, the payment is going to be lower on an FHA loan because that mortgage insurance is lower than on a conventional loan.
Yeah, and look, FHA requires 2 years after a Chapter 7 bankruptcy.
True.
You could be in a Chapter 13 bankruptcy and still get an FHA loan. 3 years after foreclosure, short sale, or deed in lieu. So those are credit characteristics that FHA is your only option, in which case FHA is a great loan. Also, debt-to-income ratios on FHA is allowed to be much higher, and they're a lot more flexible with credit just in general. Okay, and then like you said, with lower credit scores, the numbers are just way better. So there's lots of benefits to getting an FHA loan, but that shouldn't mean that should default. Let's do a proper analysis, pros versus cons. What is your exit strategy, your situation, your long-term plan? And based on that, we can do our thing.
And know why. Look, I think it's so important for the client to know, listen, why am I putting you on an FHA loan rather than a conventional loan? Show me why. You know, you're getting a big debt, and it's your right to know exactly why you're getting in this vehicle, in this form of debt. And sometimes it's extremely simple, like payments. This payment is going to be lower than this payment, and you're not going to stay in this house for 30 years.
Or because of this event on your credit, it's this or nothing.
You don't go on.
But so often, though, people go to a lender, the lender steers them in that direction with no comparison or explanation, and they're like, why are you in an FHA loan? And they're like, I don't know, that's what he put me in. So
now, on the flip side of that, same thing from the seller's perspective or from the listing agent's perspective, an FHA loan doesn't mean that it's somebody that's struggling and that the loan is not a sound loan.
Correct. They're the easiest loans to close, man.
Exactly.
And the misconception out there that it's this negative stuff, and well, the inspections, there are no additional FHA inspections.
There aren't. We don't ask for any inspections,
There
guys.
used to be, but that's just old school, man. It hasn't been that way for 15 years, 10 years.
So, listen, if there's any listing agent out there, or if there's any sellers out there watching this, guys, don't tell your listing agent to not accept FHA offers, because you're closing yourself for a lot of opportunity.
A lot of solid buyers. What do we have next here? How much money do you have to make to qualify for an FHA loan? We got to do a whole video series on that, man. That's a common question. We've addressed it already. So,
but on that, real quick, how much money you have to make? When it comes to how much money, because I get this question a lot. Hey, Ed, how much money do I need to make to qualify for a $300,000 house?
Okay, Fair?
It depends. We don't really... There's a number, and I understand. There's a rule of thumb, that's fine. But more so than how much money you make, what we care about is the debt to income, right? How much money you spend every month and how much money you make. And that ratio is going to determine how much money you can qualify for. That's why there's people that come to us that make good money, but because their debts are so high, they can't qualify for a home. And they tell you, I don't understand how I can qualify, where there's people making less money than me that can qualify.
100%.
Well, they don't have 3 BMWs
and a yacht. Yeah, I mean, look, this week I qualified one person that made $15 an hour, one person that made $13 an hour, and I turned down somebody that made $250,000 a year.
Right.
So it's all about your debts, which, by the way...
If you made $250,000, I probably won't turn you down. Just so you know.
But, look, I and this is kind of off topic a little bit, but, so many people are trying to keep up with the Joneses, which are broke, okay? And people buy stupid crap they don't need, and it screws them up. Or the person that goes out and buys himself an $800 a month car payments, and then says, what do I qualify? You qualify for the back seat of the car you just purchased, right? Now, I hope you got, an SUV so you could sleep in the darn thing.
And speaking of the cars, right before we jump in, we saw a statistic that said, like, a vast, I don't remember the specific numbers, but it was a large percentage of people that bought a house 6 months or within 12 months after buying a car.
Yeah, and it's just backwards, man.
Guys, look, if you're interested in buying a home, talk to the lender for the house before you talk to the guy at the car lot.
100%. 100%.
Please.
So then other questions. What mortgage can I afford with a 100K salary? What mortgage can I afford on 60K? So look.
Same thing, huh?
Yeah. So look, let's throw out a rule of thumb.
Yeah.
Okay. Everybody's situation is different. Your housing payment, and this is not a guideline. This is just a suggestion.
What's housing payment?
A housing payment, principal and interest. That's your mortgage.
Right.
Taxes.
Insurance. And here?
Mortgage insurance, and often HOAs.
And here HOAs. Yes.
Right. So your entire the cost of ownership, okay, should not be more than about 35% of your gross monthly income. So if you're making $60,000 a year, that's $5,000 a month. 35% of that is $1,750. Don't ask him to do fast math. That's my thing. So $1,750 a month. Now, please be careful using online calculators for how much house does $1,750 a month get you.
Yes.
Because they screw up the taxes, they screw up the insurance, and they leave off the HOAs. You just gotta I like that.
And they assume that you're putting 20% right away.
100%. Okay, which by the way,
not 100%, 20%.
100% of the time, yes. So anyway, I mean that is a rule of thumb. But again, please, guys, trust us, man, on these questions.
Well,
this
and
is
the other
not your
debts.
thing.
Let's jump in with the other debts too. The rule of thumb is you should not spend more than 50%, including that payment. So those $1,700 plus your car payment and your credit card payments, your yacht payment, all of that shouldn't be more than 50% of your gross monthly income.
100%.
Now, does that mean that we can't go more than 50%?
You can.
We can, but that's just the rule of thumb.
It's just a rule of thumb. And look, one thing that we focus on with people a lot is not strapping themselves and becoming house poor.
Not just can you, but should you?
Yeah, I mean, it's that's the bigger question is should you? Now, there are times when we're stretching those debt to income ratios, but maybe there's a spouse income that the spouse isn't on the mortgage, or there's a secondary, there's some other income stream where
there's cash.
Actual household bills and debt, their actual household debt ratio is not what the debt ratio we have in the file.
Sure.
Okay, so that factors into things. So, look, I think that's 10 questions, man. Let's keep it short and sweet this week.
Yeah, that's right.
Hey, thanks for watching. Keep sending us questions and DMing us. Anything you guys need, reach out to us. I don't know. That's what I got. Yeah, I got to go meet a well guy at my house, so I got to go.
Ooh, that's bad.
That bill sucks. All right, everybody. Until next time, man. See ya. Take care.
Guys, take care.